Last week saw the release of US PCE inflation data, which aligned with expectations, including a 0.4% month-on-month increase in core PCE. Wall Street indices rallied, nearly hitting record highs by Thursday's close, while the Nikkei 225 and ASX 200 soared to all-time highs during Friday's session. Federal Reserve members Collins and Williams hinted at potential rate cuts later in the year, with Bostic eyeing a cut by summer. In Japan, core CPI met the BOJ's 2% target, surprising markets and bolstering the yen. BOJ member Tanaka indicated progress towards the inflation goal and suggested a potential shift away from ultra-loose policy, further lifting the yen. Additionally, soft retail sales in Australia raised doubts about the RBA's hawkish stance in their latest statement. Lastly, the dollar weakened against the euro on Friday due to weaker-than-expected U.S. economic data but strengthened against the Japanese yen after BOJ Governor Kazuo Ueda cautioned against premature declarations of victory on inflation. USA. Amidst robust U.S. economic resilience, the dollar has emerged as the top-performing major currency this year, surging nearly 3% against a basket of currencies within a short span. This exceptional performance underscores the strength of the U.S. economy, characterized by solid economic growth, historically tight labor market conditions, and a slower-than-anticipated cooling of inflationary pressures. The sustained strength of the economy has compelled traders to reverse their bets on imminent Federal Reserve rate cuts. Market expectations have shifted, with only 3 rate cuts priced in for this year, a notable reduction from the 6 cuts anticipated just a few months ago. Consequently, investors foresee U.S. interest rates remaining elevated for an extended period. Additionally, grim economic prospects elsewhere in the world have bolstered the dollar's appeal. The United Kingdom and Japan have slipped into technical recessions, the Eurozone grapples with stagnant growth, and China continues to navigate challenges in its property sector. Given these circumstances, alternatives to the dollar appear less attractive. Looking ahead, upcoming events will shape this narrative further. The week kicks off with the release of the ISM Services Index for February on Tuesday, followed by the private ADP employment data on Wednesday. Fed Chairman Powell is scheduled to testify before Congress on Wednesday and Thursday, with investors keenly watching the Q&A session for insights into the economic outlook. However, the highlight of the week will be Friday's release of the latest U.S. employment report. Economists anticipate another round of robust jobs numbers, reaffirming the health of the labor market. While some early indicators hinted at a potential slowdown in employment growth in February, the overall outlook remains positive. Eurozone. The European Central Bank, ECB, is facing questions about whether it has fallen behind the curve in responding to economic challenges in the Eurozone. Ahead of Thursday's meeting, expectations are for the ECB to maintain steady interest rates, shifting focus instead to updated economic projections and any indications from President Lagarde regarding the timing of potential rate cuts. The Eurozone economy encountered significant hurdles last year, with rising interest rates dampening demand and governments scaling back spending. Germany, in particular, felt the impact as a slowdown in global trade affected its export-heavy economic model. This economic slowdown has been mirrored by a decrease in inflation, which dropped to just 2.6% annually in February. Although wage growth remains relatively high, it has started to lose momentum. Despite these signs of economic deceleration, ECB officials have emphasized that it is premature to consider rate cuts, as doing so too early could exacerbate inflationary pressures. Most officials have earmarked June as the likely time for a rate cut, allowing for access to updated wage data. The upcoming meeting is expected to serve as a precursor to potential actions in June, with the ECB reiterating its patience with regard to interest rates until there is certainty that inflationary pressures have been subdued. However, the delay in rate cuts could carry risks. The Eurozone is already facing the threat of recession, and prolonged inaction by the ECB could deepen the downturn. This could ultimately necessitate more drastic rate cuts in the future, leading to a grim outlook for the euro. The ECB's focus on wage growth, despite being a lagging economic indicator, underscores its cautious approach. Yet, waiting too long to act could inflict unnecessary harm on the economy and result in a scenario where rates are eventually slashed with significant force. While no immediate changes are anticipated from the ECB, the central bank may need to clarify its stance, especially in light of earlier debates among ECB members. The persistence of inflationary pressures, particularly outside of Germany, suggests that a dovish pivot may not be signaled in the upcoming meetings. UK. Turning to the United Kingdom, the spotlight shifts to the government's upcoming budget announcement on Wednesday. The Chancellor has signaled a desire to reduce taxes for workers, aiming to appeal to voters ahead of what is expected to be a challenging general election for the ruling party. Market reactions will hinge on the specifics of the tax cuts and their depth. Significant reductions in income tax or national insurance could bode well for the pound, as they would stimulate spending and inflation, potentially prolonging the Bank of England's commitment to higher interest rates. However, given the limited room for substantial tax adjustments, any market response may be relatively modest. Canada. In Canada, the central bank is set to conclude its meeting on Wednesday. While markets assign a low probability of an immediate rate cut at 15%, such a move is highly improbable given the country's relatively robust economic conditions. Particularly, the housing market is experiencing significant activity, fueled by record levels of migration. However, the slowing inflation rate suggests that a rate cut from the Bank of Canada is inevitable in the near future. Market expectations point to the first rate cut potentially occurring during the summer months. Therefore, the upcoming meeting may witness a subtle shift in the bank's tone, laying the groundwork for such a move. Following the central bank's meeting, attention will turn to the nation's employment data due on Friday. Additionally, investors will keep an eye on data releases from Japan, China, and Australia. Starting on Tuesday, the latest inflation statistics from Tokyo will provide insights into whether the Bank of Japan will consider raising rates this year. Australia's GDP data for Q4 will also be released on the same day, along with China's services PMI for February. While softer inflation figures may suggest a dovish tilt in the Bank of Canada's statement, the possibility of a rate cut seems remote, especially considering market expectations of a delayed Fed rate cut, possibly not until June. The bank's January statement acknowledged softer consumer spending and contracting business investment but highlighted higher wages. With growth expected to pick up in the second half of the year, maintaining the current stance seems appropriate, without signaling a dovish pivot. Commentary strategy. Next week, the Federal Reserve Chair is scheduled to testify before the House Committee, presenting an opportunity to shape policy expectations. While traders are hoping for a dovish pivot, it's uncertain whether this will materialize, potentially leading to limited volatility in the lead-up to his appearance. Last June, Powell expressed hawkish views on inflation and downplayed concerns about significant job losses. Since then, PCE inflation has moderated from 3.2% year-on-year to 2.4%, and core PCE from 4.3% to 2.8%, while employment reports continue to show resilience. This suggests that Powell may not signal a dovish pivot next week, but he could acknowledge progress on the inflation front. It's likely that Powell will reinforce the market's expectation of a rate cut around June, which aligns with economists' forecasts and current market pricing. However, if he surprises with a dovish twist, hinting at an earlier rate cut, markets could react by embracing the short USD theme and pushing risk assets, including Wall Street indices, to new highs. In addition to Powell's testimony, the U.S. primary elections will continue with 16 states voting for their presidential candidates on Super Tuesday. While these events may not have a significant impact on the markets, they could offer insights into future trends as the presidential campaigns gain momentum later this year. The ISM Services PMI will provide insights into U.S. growth prospects and inflationary pressures, particularly through the prices paid sub-index. Strong expansion in the headline index, along with growth in employment and new orders, coupled with a rise in prices paid, suggests higher inflationary and growth forces. If a similar trend emerges, it could dampen expectations of a June Fed rate cut. Regarding the non-farm payrolls (NFP) report, job growth remains robust, and unemployment remains low by historical standards. This reinforces the Fed's stance of no rush to announce rate cuts. While prior employment reports such as Challenger job cuts, initial claims, and ADP data could influence sentiment towards the NFP report, It would likely take a significant miss in job creation for a rate cut to be justified at this stage, especially considering the strong job additions in the previous month. Euro-USD range. The FX markets have been exceptionally subdued lately, as evidenced by a striking statistic. Euro-USD is on track to record its narrowest weekly range since November 2019, at just 70 pips. This begs the question, what will break this pattern? This week's inflation data from both the Eurozone and the US had minimal impact on central bank rate expectations, largely because market pricing now aligns closely with policymakers' projections. The Federal Reserve's pricing matches the dot plots, and European central bank hawks believe that rate markets are adequately priced. While Eurozone inflation slightly exceeded expectations, the overall disinflation trend remains intact. However, concerns persist regarding services CPI, which posted its largest monthly increase since April. Conversely, the solid US core PCE print was in line with forecasts. Looking ahead to next week, there are several potential catalysts that could inject volatility into the market. These include rate decisions from the ECB and the Bank of Canada, Fed Chair Jerome Powell's testimony before Congress, and the release of the latest non-farm payrolls report. For Euro-USD, given the exceptionally narrow range, familiar parameters apply. Resistance is seen at 1.0880-1.0897. Representing the 55-day moving average and February peak, acting as a barrier to further gains. On the downside, support lies at 1.0790-1.0800, limiting potential pullbacks. USD potential. After experiencing significant gains during a tightening cycle in the United States, the dollar now has the potential to rise even further. This is supported by its high interest rate, which is the highest among major currencies and surpasses that of some emerging market currencies. It's highly unusual for the main interest rate affecting the dollar to be higher than those of riskier emerging currencies, as central banks of those nations typically follow the lead of the Federal Reserve. During the period when U.S. interest rates surged, several emerging nations, as well as some major ones, diverged from tradition, resulting in predictable outcomes. Many currencies, including those of South Africa, Malaysia, Turkey, and India, have plummeted towards record lows. Even currencies like the euro and the pound, which have rates closer to those in the US, have weakened significantly. Japan's yen, being the only currency affected by a negative interest rate, has also declined to a record low on a trade-weighted basis. Currencies of nations contemplating or implementing easing measures, such as Thailand, Czechia, China, and Hungary, have faced pressure this year as expectations for U.S. easing have been pushed back. The primary U.S. interest rate, which was around 4.5% in December, continues to be attractive to traders. Whether they are considering carry trades that thrive when stocks rise, or are concerned about a potential stock market downturn that would fuel risk aversion and support the world's reserve currency. After retracing half of the rally seen during the period of rising interest rates to alleviate an overbought situation, the dollar is poised for further appreciation. Unlike in 2022, when overcrowded investments in dollars led to a drop, there is currently almost no speculation on the dollar rising. With this burden lifted, the dollar could potentially increase in value by as much as 10%. USD/JPY. USD/JPY experienced a sharp rebound after Thursday's decline but was unable to surpass the trend highs of 150.88 set in 2024. This rebound was hindered by much weaker than expected ISM manufacturing and Michigan sentiment data, which caused Treasury yields to decline and increased the pressure on bulls ahead of ISM services and crucial employment data next week. Thursday saw profit-taking at month-end, exacerbated by supportive comments from Bank of Japan (BOJ) and Ministry of Finance (MOF) speakers, resulting in a bottoming out near the key session range of 149.23–150.88 observed on February 13. The rebound following the ISM miss was supported by BOJ Governor Kazuo Ueda's less certain stance on inflation prospects. Additionally, Japan's February manufacturing PMI fell to 47.2, its lowest level in 3 years, from 48.00. The initial decline in Treasury yields on Friday was attributed to concerns about New York Community Bancorp's issues. However, yields in USD/JPY rebounded after comments from Richmond Federal Reserve President Thomas Barkin, who indicated openness to interest rate reductions this year. Despite this, the spread between two-year Treasury and JGB yields has narrowed by 18 basis points from 2024 highs, while two-year Treasury yields have dropped by 10 basis points. USD/JPY has also retreated from Friday's high, falling short of the 2024 uptrend line broken below on Thursday. The halted uptrend now faces the burden of next week's key ISM non-manufacturing and employment reports, compounded by Friday's dovish data. GBP/USD. GBP/USD remained near the lower end of its weekly range of 1.2700–1.2614 during North American trading, hovering around 1.2625. The slowdown in the downward momentum of inflation in both the UK and the US is expected to keep the currency pair within a tight range. Recent data from the US and UK has done little to alter the narrative of steady rates for both the Federal Reserve Fed and the Bank of England BOE. Despite the slight beat in Friday's February UK manufacturing PMI data, which remained below 50 indicating contraction, suggesting overall weakness in the UK economy, cable's modest initial rise reversed after comments from the Fed's Tom Barkin during North American trading. Barkin indicated that he still sees wage and inflation pressures and is not rushing to cut rates. While the UK is likely to maintain a slight rate advantage over the US due to persistently high core and headline inflation, recent less dovish comments from Fed members are gradually eroding that advantage, both in absolute terms and relative to the US. Under current circumstances, the pound is expected to continue trading within its 2024 range as UK and US rates remain stable. However, this range is likely to be tested in the summer when both the Fed and BOE are anticipated to pivot towards lower rates.
Audio Jungle.